Hey everyone, and welcome back to the Fish Market Academy, where we teach how to fish for gains. So in today's video, we'll be exploring the MAS protocol as well as its valuation. So if you found this video useful, do remember to like and subscribe, and let's get started. So disclaimer, nothing I say is financial advice. So let's recap what MAS protocol is about first. So MAS is a fully automated decentralized bank, also known as a money market, built on the Terra blockchain, and it supports non-custodial, over and under collateralized borrowing. So basically, users can issue collateralized debt, as well as smart contract developers can issue uncollateralized debt that has to be approved by the governance council first. And what's interesting about MAS is also the fact that it uses a dynamic interest rate model that allows for the interest rate to be changed when depending on the demand, so that they can achieve optimal utilization and capital efficiency. And of course, MAS is used to earn protocol fees as well as participate in governance, which also includes the approval of whitelisted smart contracts for the uncollateralized debt. So let's summarize the timeline. So by the time you're watching this video, you can no longer deposit, and you can only withdraw. And after that, you can go into phase 2, where you do the LBA, liquidity bootstrapping auction, where you can provide UST or MAS to the bootstrapping pool. And then after that, finally on the 7th of March, MAS will launch and you can use the MAS protocol. So let's explore the MAS tokenomics again. There is 1 billion MAS token, and 7% of it will be for the lock drop and airdrop, and 10% of it will be in the MAS reserve, and this is not circulating supply. And then there will be 30% for joint venture partners, and a large majority of it will be to the community at 53%. Just take note that the TG date is 7 March, and the team cliff will be 1 year later on 7 March 2023. So this is the MAS emission schedule, assuming that the community is released linearly over 48 months. Yeah, for this community pool section. So let's explore the valuation analysis, which is what we are here to understand. So we went through the various money market protocols across the different chains, and we excluded Ethereum as well as Aave and Compound, because we feel like their MCAP and TVL against the giant that is Ethereum is very skewed and insignificant, so we didn't include it. But we did include the other chains from Avalanche, BSC, Phantom, Harmony, Solana. So we'll be using 3 main methods, actually kind of just 2 main methods to find the valuation of MAS, mainly the MCAP of the main money market fund versus the MCAP of the network, as well as the MCAP versus TVL of all the money markets average. So let's explore how that's done. So for MCAP of main money market versus the MCAP of the network, these numbers are taken on the 24th of February, so they might be slightly outdated. We basically use like Anchor, which is like the money market divided by Terra, and so that gives us a ratio of 3.13%. And then we did the rest, like Banky versus Avalanche, Venus versus BSC, Guys versus Phantom, Tranquil versus Harmony, Solan versus Solana. So something to take note is that we didn't use Anchor because we felt like this was an outlier, and Anchor is not really a money market compared to MAS, or compared to the rest of this, because it can only accept yield-bearing assets like Biluna, BEF, and it's not like the rest where they can accept many different types of assets, even if they're not yield-generating. And Tranquil Finance is a bit skewed also, because they are copying DFK and turning into a game that has a money market inbuilt, so that's why it's at a higher percentage. So if we find the average of these figures, we get a figure of about 0.446%. So just to reiterate, that is the ratio between the market cap of the main money market protocol versus the market cap of the underlying L1 network. So if we take this average at around 0.45%, then we can assume that MAS market cap will be worth about 0.45% of Luna's market cap at TGE. So if we do the math, we basically use the circulating supply at TGE, which is 16 million tokens, times the price of MAS, which we want to find, divided by the market cap of Terra, which skyrocketed to 29 billion, and equate that to 0.45%, we get a rough estimation of MAS being 2.17. So this number, just to clarify, can be quite different depending on whether you use Tranquil or not. If you don't use Tranquil, then the number might be even smaller. Alright, now let's look at the other approach where we use the TVL of money markets versus TVL of network. So again, Anchor has a really skewed figure because the bulk of it is just in UST. And if we just look at the rest, then we get a rough average of about 15.58%. So this is the TVL of the money market versus TVL of network. Okay, so using this 15.58%, let's find out what is Mars' estimated TVL. So we will take the Mars TVL equals to 15.6%. I kind of like rounded it times 21.8 billion, which is Luna's TVL. That would equate to an estimated TVL of 3.4 billion. So we'll use this in our next slide. So the MCAP over TVL of all the various money market tokens gives us an average of about 2.85%. Again, Tranquil has a slightly outlier data at 5.54%, but we decided to use it anyway. And if you were to not use this data, then you might get a different figure. So if you average everything out, you get about 2.85% as the MCAP over TVL of money markets. And if you put that figure in, the MCAP over TVL equals to the MCAP divided by the TVL, and then you get 2.85% times 3.4 billion, which is the estimated TVL. That would equate to an MCAP of 96 million upon launch. And MCAP equals to mass price times circulating supply. So if you move the figures around, mass price equals to MCAP divided by circulating supply equals to 96 million divided by 60 million tokens. That would give you $1.61. So mass would be fairly priced at around $1.61 using this method of valuation. So you get a rough range of 1.61 to about $2.20. And of course, the methods that I mentioned, if you were to remove Tranquil, you will get a slightly lesser number. So you might want to factor that in. It might be about $1.20 to $1.80 instead, depending on how you use the numbers and depending on how you calculated the TVL of the various protocols as well. So let's explore valuation premium for Mars. Mars could have a higher ratio multiplier as the first money market with a token with dynamic interest rates on Terra as its unique feature. So although Edge Protocol is out, Edge Protocol, I'm not sure when is the TGE for their token. Maybe Mars will be first, and if Mars is first, then it's the leading one and it might have a higher market cap just because it's the first mover. It will also continue to grow in terms of volume, TVL, and MCAP as well start to utilize the protocol for borrowing and lending. I can imagine a lot of institutional clients or funds, crypto funds coming in for their borrowing and lending, especially if there's their incentives, and then that could increase the TVL and MCAP, which could create more of a premium. Additionally, Mars also has this new primitive in the form of uncollateralized borrowing via smart contracts without having a fixed duration for the loan to be paid back. So this is innovation, and innovation would cause valuation to be higher potentially as well. Additionally, it has very strong credentials backing it from Delphi Labs and Ideal Collab Ventures. So if the protocol has very known developers building it, it's usually going to create a premium as well for the valuation. But there could be a valuation discount. So the methodology that I used just now as I described can have flaws. So you might want to discount 15 to 50% to be more conservative. And additionally, Astropod did not launch too well in terms of price action because not all the features were there. And people might be wary of this and they might just want to straight away dump Mars price, no matter what price it is, in a very irrational way. So that might be one of the potential discount on valuation, at least initially. But there was a beta test for Mars, so at least we know that the product is actually there and it works. So let's explore which lockup duration is the most worth it from 3 months all the way to 18 months. So if you see from this chart, giving duration of 18 months is actually the most worth it because you get 257% of ROI instead. So this is unlike the Astropod lock drop where you want to actually lock for the shortest amount of time. In Mars case, the longest amount of time you lock for allows you to get the most amount of ROI, which kind of makes more sense. And if you look at what the market is doing, the market is also understanding that the longer duration of 18 months is the most worth it, and they are putting their money there as well. So in conclusion, if you factor in a more conservative discount to my price valuation, then you might get a fair value of about $1 or less than that, depending on how conservative you want to be. And if you use that value of about $1 or less on Mars and the current TVL inside of Mars, and if you look at the amount of UST that is being lock dropped for Mars, which is around like 170 million, by the time it's over, it might even be higher. And assuming nobody actually leaves, then you get an estimated ROI of about 30%. So if you think about 30% for 18 months, that's kind of the same as Anchor for 18 months, where you get 20% per year. So 18 months is about 30%. And therefore, may not be the most worth it if you are looking to trade actively, because then your UST is not available and it's inside the mass lock drop. But it might be worth it, right, for passive investors who are not using their UST anyway. So if you are kind of like a long-term UST hodler, then you might just want to keep your UST in mass because you think prices will continue to go down and there is no rush to use up your UST. And to clarify on the active traders, if you are looking to buy dips, especially the mega dips like what happened recently, then you need your UST to be liquid so that you can buy the dip, and then that's probably more worthwhile in terms of returns than locking it up for mass. So depending on the type of investor you are, you can act accordingly. So my opinion and what I did might be a bit controversial, so I'm not really sharing it publicly for this video. But if you are interested, I did share it with my private group, and you can join it in the link below. I'll put the link in the description. So ultimately, at the end of the day, do your own research and invest with caution. And if you guys found this video useful, do remember to like and subscribe, and I'll see you guys again soon. Bye!
Baby fish do 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 do, baby fish do do.